We had a bit of a sell-off day on Wall Street with the S&P 500 down about 1%, and it was a broad-based sell-off today with the vast majority of stocks closing in the red. Only 17% of stocks closed in the green, and really the only consistent outperforming sector was energy. Oil and gas stocks did tremendously well. Pretty much all the other sectors suffered, with the utilities and REITs really struggling here today. We'll take a look at all of that, see what it means for our overall postures. We'll also get a sense of what to expect out of tomorrow's big jobs report and how the markets could break in one direction or another. And then we'll get into our trade application example where I wanted to once again concentrate on the consumer discretionary space. But unlike Tuesday's bullish trade I did on Starbucks, in tonight's video, I wanted to do a bearish trade on Dollar Tree. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 6th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. You can also look to see which stocks in the S&P 500 are giving us any overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, we've got the S&P 500 heat map pulled up in front of us. And unfortunately, it was a pretty lousy day, a lot more red than green, as you can see. Actually ended up closing lower by just over 1% today. And that didn't get done in terms of getting down more than 1% until just the last 5 minutes of session or so. So for most of the day, we were down, but not quite 1%, kind of in the 0.5% territory. So it wasn't the worst day we've ever seen, that's for sure. Really, we're just still kind of digesting the major gains that took place on Monday and Tuesday. And the good news from that perspective is we haven't given back a lot of those gains. Tomorrow represents an opportunity for further give back. Then again, it could also represent an opportunity for a big move higher. We'll just have to see. But the reason I say that is tomorrow is an important day from an economic report perspective, as we've got the non-farm payrolls number coming out. And the market will be watching it quite closely. And from what I can tell, the market probably would prefer that number to be a cool number, not a hot number. If the job market is too strong, it will give the Fed more firepower to further increase interest rates even beyond what the market is already absorbing. On the other hand, if the job market cools down considerably and there's a number of layoffs and fewer people sitting at home and more people, trying to lock down jobs before the economy gets too weak, that could be a message to the Fed that their crusade against inflation with heightened interest rates this year has been working and might give them a reason to kind of slow their roll a little bit in terms of what they expect to do with future increases of interest rates. So tomorrow's going to be a big day. We'll find out how that shakes out. And of course, David will be with you this weekend to give you the breakdown of however that turns out. But on the eve of that number, you can see it was a little bit of a whimper here for the market today, with most areas closing in the red. I would say that the one exception to that appears to be energy. If you see down below here towards the lower right, most of the energy stocks were up today. If I were to right click and then zoom in only on the energy sector within the S&P 500, you can see most of the energy stocks were up today. We really only had Kinder Morgan, Williams, and ONEOK in the red. All the rest of the energy stocks were in the green, and that is quite different than every other sector on the board. You had a few patches here and there, like in the consumer discretionary area. I can see, again, there's Las Vegas Sands. It seems like that name has come up more times than not recently, as we've been talking about some of those casinos. I also saw some good news, by the way, after hours tonight on a trade that we have on right now, an existing trade, and that's DraftKings. Obviously not a physical casino the way that Las Vegas Sands is, but DraftKings, we have that. I think it's a bull put spread on right now. And there was some news floating around after hours tonight that DraftKings and ESPN were going to have a further partnership. So that stock was up about 10% after hours the last I checked. So maybe some enthusiasm there still around some of those casino and gambling types of names. You saw that Home Depot and Lowe's managed to close in the green today. You saw that some of the streaming names like Netflix and Warner Brothers closed a bit higher today. Some one-off healthcare names like Dexcom did pretty well there. Eli Lilly has been a workhorse. That's one of the very few stocks that's hitting all-time highs here within the last week. Not a whole lot of companies can make that claim. We actually talked about another one of those in my question and answer session class today with LPL Financial, is also hitting an all-time high. But there's not a lot of them out there. There's probably only maybe a dozen or two total stocks in the thousands of stocks here in the United States that can make that claim. Most stocks obviously are much closer to 52-week lows than to all-time highs. But Eli Lilly has been a workhorse. It happens to be one of the stocks we own in our top-down trend trading class, so we're thankful for that. But we'll see if it can last or not. But they've been making some waves with a weight loss drug here today, and in addition to some positive vibrations around their Alzheimer's franchise here a week or two ago when Biogen got some good news on that front. So Eli Lilly seems to be one stock that's been able to withstand the pressures of this market so far. And that's saying something because not a lot of companies have been able to do that at all. In terms of the areas that seem to be struggling the most, tech didn't do particularly well. Of course, Microsoft and Apple being the two most important companies in the S&P 500 due to their market cap, so they didn't do the market any favors today. But even as you go, a little bit into the smaller companies in like the semiconductor world, they were largely lower here today as well. And unfortunately, there was further bad news after the bell. AMD came out, and you don't see it here because this is the normal session where it was only down 0.13%, but in the after-hours session, they were down about 4 or 5% on an earnings pre-announcement. So the bad news keeps on coming in for some of those semiconductor companies, and that might tilt the scales more bearishly for the semiconductor stocks starting tomorrow morning, because AMD is one of the most important semiconductors out there. But of course, that needs to be weighed against what's happening in the general market with however it responds to the non-farm payrolls numbers. So we'll find that out. But in the after-hours session here tonight on Thursday, AMD is struggling. I would also point out that pretty much everything off to the right-hand side here was really in the red. And in particular, take a look at utilities and REITs. Remember on Tuesday when I was with you, I was highlighting how utilities had fallen off the map on my sector selector rankings, where they had been ranked number 1 and they fell all the way to 8th place into the lower half of the rankings. Well, they still can't seem to get themselves out of their own way. If I zoom in on the utilities here, notice that utilities were down across the board. Every single utility in the S&P 500 down today, and many of them down pretty significantly. Remember, they are usually boring areas of the market, but Dominion was down 4% today. American Electric Power was down 3.6%. Duke was down 3.5%. NextEra Energy down 3.5%. Southern was down over 4%. So these are some pretty large moves. Excuse me. Still dealing with this darn cough from COVID, so that's going to creep up here and there, so I apologize. But anyway, that's a pretty large move for a utility stock, right? They're generally going to move less than 1% on any given day to either the plus side or the downside, but today it seemed like the typical utility was down about 3.5 or 4%. And that's probably as a result of some of the interest rate sensitivity finally catching up with it. Let's go ahead and also take a look at the real estate area, since we're on that topic of interest rate sensitivity. And you can see the REITs got hammered today as well. Now, just disregard this Duke Realty one here. I believe that was the one that got bought out by the next door neighbor there, Prologis. But Thinkorswim has not updated their heat map by taking it off of this yet. So this one actually wasn't really up today because it wasn't really trading today. But it's just stuck in here until Thinkorswim does a little bit of housekeeping. So you could basically say that all REITs and all utilities were down today. That is a clean sweep. And you can see some of the bigger ones like American Tower really got punished, down 5% here today. Their competitor, Crown Castle, another cell phone tower REIT, was also down over 5% today. So some pretty ugly action there across the board in some of those interest rate sensitive areas. So, not a whole lot of good, positive bullishness to hang our hat on here today. Then again, it wasn't a complete wipeout like we had been experiencing at the end of September either. Let's go ahead and now advance our thoughts on over to the specific statistics within the S&P 500 in terms of advancers versus decliners. And as you can see here, we had 87 stocks out of the S&P 500 closing higher today. That was good for about a 17% hit rate. So obviously a market that was clearly on the side of the bears here today, even though it was only a 1% down day on the market. So definitely negative breadth across the board here today as we await that important jobs number tomorrow. Let's take a look at our charts now. And whenever we move 1% in one direction or another, I like to start our conversation off with chart 6D here. Remember, for those of you that are premium members, you can follow along with David and I's charts as we offer that as part of our 3-year premium package. You guys get access to all 50 plus of our charts. And remember, with next month being November, we'll probably be running another Black Friday sale as we pretty much do every year. So if you're thinking about joining our premium program, this is a good time to be considering that. But anyway, this chart 6D will help us kind of visualize whether there's been more volatility or a lack of volatility from a slightly different perspective than just simply looking at the stocks chart itself. And down in the middle area here, you'll see kind of this this graph that stretches either up on the bullish days or stretches down on the bearish days. The bullish days, of course, highlighted by green bars, the bearish days highlighted by red bars. This happens to be a 1-year, 1-day chart here. And as you can see, we have had a fair bit of volatility recently. At the end of September, most of that volatility was to the downside. Today we stretched to just barely touch that blue line, which is a 1% down move. It was actually down 1.02% to be exact. So, and as I mentioned before, it just barely got there at the end of the day. For most of the day, it was not down 1%. It really just hit that right within the last 5 or 10 minutes. So all in all, it was somewhat of a quieter day. In fact, you can see up here in the daily range, we only moved about 58 points on the S&P 500. The typical range here recently has been closer to 85 points. So while in other eras where we have a relative lack of volatility, a 1% down day might be considered a pretty big move. But when you compare it to most of the activity we've had here in recent weeks, it's actually a quiet move when the market is only down 1%. So my oh my, how times have changed. Remember, just a couple of years ago, like 2020, actually just last year, 2021, we had hardly any pullbacks at all in the market. It really wasn't until November of 2021 when we first started experiencing a little bit of volatility. But from January until November, we had hardly any movement within the market. In fact, I could probably highlight that here by showing us let's go to a 2-year chart and just show you the contrast of what we've been dealing with here this year compared to the previous year. So the crossover on the year is approximately right here. This is that November 2021 time period that I was mentioning. And look at the difference in the candles to the left versus the difference to the candles to the right, or the bars to the right. These bars here to the right are stretching violently higher and stretching violently lower compared to what we had experienced in 2021. And look at how peaceful that time period was back here, where the market just gently marched higher week after week, month after month. Oh my. We didn't know how lucky we had it back then. We do now, after we've gone through the chaos of the last 9 months of 2022. So today was, I guess you could say, somewhat of a big down day, but compared to the other bigger down days we've had lately, it was quiet compared to them. So today would have been a big down day compared to 2021, but is not a big down day compared to what we've dealt with in 2022. So volatility continues. And you can see that the VIX did stretch back up above 30 today. Remember on Tuesday I had mentioned that it had fallen down to 29, and 30 is a nice round number that traders keep their eyes on, and so we're back above 30 just barely here as we head into the non-farm payrolls number tomorrow. And so there is a heightened sense of volatility. It's not capitulatory volatility yet. We're all kind of waiting for that just enormous spike to 40 or 50 on the VIX, like we oftentimes see in bearish markets of the past, and we just simply haven't seen that yet. But it is also true that 30 is a lot higher than average over the last couple of years, and so it is a recognition at a minimum that there are concerned people out there that are buying puts to hedge their portfolio for sure. All right, let's get back on over here to our typical routine now, looking at our 4 grid. This is chart 4B for those of you following along at home. And this will allow us to see the 4 major U.S. equity indices, try to get a gauge of what has been happening within the markets here over an intermediate time period. Remember, each of these charts is 3 months in length. And there was something noteworthy that happened today, and that was that we did get some more bullish postures appearing. Remember, there's a delayed effect there, and so without Monday and Tuesday happening, we likely would not have a bullish posture today, but it's a recognition that we had a big move higher, and it was not immediately followed with a washout of that big move back to where it was, right? If yesterday and today would have completely reversed Monday and Tuesday, we would not see that the background color of the chart would be light green right now. But because they've basically been able to hold those higher levels, it allowed this green line on the market forecast to rise up. Let me right-click on this chart so we can all see it a little bit better. And you can see here that this green line has now gotten up and out of the lower reversal zone. Just barely. It's at 21 right now. And remember, the lower reversal zone on the market forecast technical indicator is 20. So it just barely got out of it, but that's all it requires. And so that posture setting mechanism changed the background color of the chart to that light green to identify that. Now remember, this green line is going to have to stretch all the way above the 50th percentile before that light green color turns to a dark green, if that is going to happen. Remember, in order for that to occur, it's likely going to require this market to get up and through this downward trending 30-day moving average. And that's not going to be any easy feat in all likelihood. We can see exactly what happened the last time we attempted to get through the downward trending 30-day moving average back here on September 12th. It was summarily rejected, and it wasn't even close. Sometimes, it makes you wonder, okay, you sit there for a day or two wondering if it's going to hold. Well, this one didn't. It kissed it, and that was it. You had your one chance to get out at the moving average. The next day was a gap down lower and really disrupted a lot of portfolios. That was that big 4% down day, if I'm not mistaken. So anyway, you at least have some green shoots here to work with, but I remain a little bit more hesitant and cautious personally. Then again, that's my personality in general, so take it for what it's worth for who the messenger is, I suppose, in this case as well. But I personally, am approaching this market with more cautious, hesitant mindset. I don't necessarily look at this and say, okay, that was it. We're off to the races now. And there might be some people that believe that. And, for what it's worth, they could be right and I could be wrong. That's the beauty of looking at the charts every day the way that we do with these videos. It forces us to show our hand, and it forces us to admit when we're wrong. So if that is in the cards and the market just rockets higher from this point forward, eventually we will have to change how we perceive these markets as well, because the technical evidence will suggest that whatever our prior mindset would have been was wrong. But until then, the reason I remain hesitant is because we are continually trading below this falling 30-day moving average. If the market could get up and above that moving average, I'd be a little bit more flexible in my thinking. But until then, I just remain a bit cautious, because more times than not in the year 2022, rallies have meant to have been sold and not an excuse to buy. And if you've used them as an excuse to buy, you've usually ended up regretting that decision. So we'll just have to see. Can the market go up a bit more? Of course, we've got a gap between the moving average and here, so I'd personally like to see it get up to the moving average at a minimum, and then see how the market wants to react there. So it doesn't mean that we have to go lower from this point forward. We've got some work to do to the upside that could very well start with a big move tomorrow after the jobs number. So we'll just have to see. But until we spend considerable time above that moving average, you'll probably find that I remain somewhat hesitant in my sentiment and these videos. So we'll find out together where we'll go. The good news is we are, kind of approaching a more positive time of the year from a seasonality perspective, and that could assist the bulls in their effort to get us above the moving average. So, and then we, of course, also have other things to keep our eye on, like Russia, Ukraine. Who knows? Maybe that wraps up peacefully. Maybe that kind of spells our inflationary concern by sending commodity prices lower. Maybe the earnings that we're about to hear from the banks here within the next week or so will be a lot better than what is feared. There's other things going on politically. Earlier today, President Biden had some news in the marijuana space as just one example. So a lot of the marijuana stocks were going crazy today. So you just don't know, as we head into this midterm election, what the politicians will say to try to kind of spur along votes, and how that will impact the markets. And so there's a lot of balls in the air, but remember, that's always the case. It's never a layup in this business. There's always concerns and things to consider, and that's why we try to allow the charts to guide us here in these videos, because the charts should be interpreting all the data at once and giving us a glimpse into how the market is interpreting it. So the good news is we are back to a weekly bullish posture on the S&P 500. The bad news is we do remain still at this point in a downtrend underneath that falling 30-day moving average. You'll notice that the Dow Jones Industrial Average was also down over 1% today. It was down 1.15%, and similar conversation to the S&P 500. It went to a bullish posture today. That, by the way, is somewhat interesting and not expected, in that typically you don't get a bullish posture change on a day when the market was down over 1%, right? Today was a bearish day for the market, but from an intermediate time perspective, when you're reviewing enough of the past data, because we're basically holding Monday and Tuesday's gains for the most part, it allowed that intermediate line to kind of have that delayed response higher. So, but it is a little goofy. Usually you probably wouldn't assume that off the cuff, that the day when you go back to a bullish posture is a day when the markets are down more than 1%. But it just happened to shake out that way this time around. On the charts down below, you'll see the NASDAQ was down 0.68%. So that was kind of interesting about today as well. It seemed like the growth names held up better than the traditional value names. Some of the more disruptive, innovative companies like Zoom Video, as just one example, were up today. I think Peloton was up as well, but that might have been from a company-specific news. But some of those kind of COVID plays and more technology-focused areas did seem to hold up a little bit better than what we saw with a lot of the traditional areas. So that allowed the NASDAQ to actually hang in there better today. And again, that's a little bit different as well. Usually when we have a down day, the NASDAQ is down more than the S&P 500 and Dow, but today that did not occur. You can see that the NASDAQ still is dealing with, excuse me, their strongly bearish posture. The reason for that is, notice down below, so let me right click on this as well, maximize the sell, and you can see that the green line is rising like it was on the S&P 500 and on the Dow, but in this case it hasn't quite broken the 20th percentile yet. It's at 18 and rising. So that could happen as soon as tomorrow, especially if the market's response to the jobs number is a positive one. So be on the lookout for that as soon as tomorrow. Over here on the Russell 2000, that was actually the day's best performer. It was only down 0.58%. And you can see that the Russell 2000 actually gave way to a weekly bullish posture yesterday. So it kind of led the Dow and the S&P in that regard. The small cap index was already at a weekly bullish posture yesterday and continued to be in that weekly bullish posture today, with the green line continuing to rise. You can see the green line on the Russell 2000 has the highest reading out of all four of these charts. It's at 25. So that's one way to identify that. You could probably get away with saying the Russell 2000 is currently this market's leader amongst these four broad indices. You can also see that the Russell 2000 appears to be closer to its 30-day moving average than the other four, which is another way to kind of judge whether it's been a more recent leader or laggard. I think to my eye, it appears that the Russell 2000 is a little bit of a leader right now. Now, that's not saying much because even it is still below its falling 30-day moving average, but you're always trying to glean some insight from the markets. What's doing relatively better, what's doing relatively worse, and right now it does seem like the Russell 2000 is the one that is doing the most work and putting in the biggest effort to try to change its trend. And it's going to have a tough time doing it as it faces its moving average. But of these four indices, it's probably got the best shot of accomplishing that because it's in the leadership role right now. You'll notice that all four of our indices do have a blue label at the top of their charts, which is telling us that their movements today were quiet compared to typical movements of those various charts in recent weeks. And so quiet day across the market as we await a very important number tomorrow morning, but we definitely had a decidedly bearish tilt towards today's trading, where we had certain sectors like the REITs and utilities that really struggled and really only had one sector, energy, that kind of pulled its bullish weight for the markets today. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these free videos that you find on YouTube. And the best way that you guys can help David and I along with that is by clicking like for us on Twitter. That helps us because it helps send our information out to a much wider net, your social networks. When you click like, then it shows up in your friends' profiles and the like, than we would be able to do on our own. So that's why we help encourage you to do that. It also helps you because Twitter, like a lot of social media companies, uses an algorithm to try to determine what is content that you want to see more often in the future. And assuming that you are a regular viewer of these Market Outlook videos, you probably want to see more of David and I's content, not less. And so one way to train Twitter to do that is to regularly click like on our content, like these Market Outlook videos. So as I always say, as long as we're getting up and over 100 likes, I'm happy to dedicate 3 hours of my day to do these videos, because there's a lot of prep work and recording and editing and sending out of the emails and the social media and the writing up of the paragraph every day. There's a whole slew of things that goes into doing what you guys get delivered to you for free. So bare bones minimum thing that we ask out of you to do if you want to see these videos continued as often as possible in the future is just simply take 5 seconds out of your day. That's all you need to click like for us there on Twitter. You guys were called to action on Tuesday, and you stood up and tackled that challenge like a bunch of champs. 125 of you clicked like, which is well beyond the 100 I would need to get this full-length video that you're listening to right now. So thank you to SW, thank you to Gerald, thank you to Ron, thank you to Margie and Adrian and Paul and Ram and Brandon and Camilla and Dr. Bob and Sonia, HR, Tom, David, Jeanette, The Real Fact, Catherine, Deborah, Kirk, My Info, I think that's Julie, Damon, we've got Roger and Marco and Bob, T-Fib, we've got Ayakipa and Carlisle and Paul and Common Sense Investing and Susan, Jim, Dave, Carl, Tammy, Dave, and others. Can't go through all of you, but I tried to rattle off as many as I could in a short amount of time just to acknowledge your effort. I really do appreciate that. Please keep it up on your end, and we'll do our best to try to deliver as many free videos for you moving forward as well. If you guys can get me up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be happy to give you another full-length video with a trade application example. If you would prefer the shorter video that's only 15 minutes in length with no trade application, then don't click like, because if we're under 100 likes, then that's what I'll put together for you on Tuesday. So I'll let you guys all decide that collectively. Also, while we're over here on the internet, just a reminder of some of the great content that was put together for our premium members earlier today. David taught his very excellent portfolio management with ETFs class. So it's always great to hear his opinion on where we stand with things from a macro perspective and how we should be positioning our portfolios with ETFs based upon his expectations for the future after kind of reading the tea leaves from the Fed and things like that. So he does an excellent job with that class every Thursday. And the class that I teach on Thursdays is what we call our question and answer sessions that we do for our Q&A, for our premium members. And David and I each teach one. I teach mine on Thursday mornings, and David teaches his on Saturday mornings. And it's an opportunity for our premium members to work directly with David and I and ask us direct questions. And as always, we had some excellent questions here today. We had a question about looking at Southwest Airlines business model. We had a question about how do we look for superior dividend growth companies and use two different companies as an example, Coca-Cola versus AbbVie, and how do we think about which of those would we choose and some of the metrics that we would look at, like payout ratios and years of growth, and quite frankly, looking at the art form of investing just as much as the science of investing by considering the future in terms of business models and what you're willing to assume in terms of risk for your own personal portfolios. Also had a question about reviewing AbbVie specifically and some of its dividend metrics. Also had a question about break-even points when it comes to selling puts and how we want to think about rolling our sold puts at a credit down and out on the day when our strike gets breached. I also had a question about LPL, as I mentioned earlier, as one of the very few companies that is hitting all-time highs in the stock market. We actually just reviewed that in a recent factor-based swing trading class. But that's one for those of you that are trend traders as well. There's not a whole lot of great-looking trends out there, but LPLA is certainly amongst the strongest stocks out there right now. The question kind of revolved around, would rising interest rates help or hurt that company, along with a conversation about traditional finance like banking companies and how we think about rising interest rate environment. Also had a question about different toss settings or thinkorswim settings when it comes to looking for where a stock would need to trade to in order to have an option worth a certain price in terms of open orders. We also had a question about how to set up our middle trade grid on the trade tab and how you can set up your charts to look like mine. And then we had a question on risk management for the top-down trend trading class, and a discussion between, what's better between setting stop losses versus kind of a rotational strategy. So if any of that content sounds interesting to you and you are already a premium member of Market Scholars, you can go back and watch that recording that is now posted to our Trading Rooms calendar. And remember, when you become a premium member of Market Scholars, you don't just get access to the classes that we have taught recently. You get access to all the classes we've ever taught. So for those of you who will be joining us next month with our Black Friday sale, remember, you could actually come back and watch the recording of this class that I taught today if any of that content sounded interesting to you as well, because once you become one of our 3-year members, you could theoretically go all the way back 5 years ago and watch our classes from way back then. We've literally got thousands of hours worth of content that you can tap into here at Market Scholars. Also, let's have a little chat about the factor selector. And it's kind of interesting to see momentum back up at the top. Now remember, this was put together as of Tuesday's closing price information. And remember, we had an enormous Monday-Tuesday rally this week. So momentum and low size are probably the two most speculative factors of these 6. And so not a surprise that after a massive 2-day rally, they were the ones that worked their way higher in the rankings. And then the more defensive areas like value, low volatility, and dividend yield controlled the bottom half of the rankings this time around. Also remember what I had just mentioned here earlier with utilities and REITs really falling off the map, not just today, but earlier as well. That's somewhat being reflected here, but today's movements are not even being captured by this graphic, but it is at least a confirmation that what this graphic was telling us on Tuesday night continues to be true here on Thursday night, which is utilities and REITs are a big chunk of those dividend yield and low volatility areas, and that's an area that is just getting stomped on right now on a comparative basis. All right, let's go ahead and get back on over here to the main part of the platform. And let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that the background colors of these miniature 12 grids will tell you what the current intermediate posture is according to the market forecast technical indicator. So it doesn't give you the back and forth background colors the way that our bigger charts do, because it would be just too hard to make heads or tails out of it. This is telling us what the current posture is as of today's close. And so as we look at these, you can see that we do have more green charts than pink charts on the board, so that's a positive sign, I suppose. But like I mentioned on Tuesday, be careful counting out the 10-year Treasury yield. Remember, on Tuesday, it was a bearish posture. And I was saying, I don't really want to read too much into that bearish posture because it's still trading above its rising moving average, and it is more likely to bounce than not. At least that was my impression. Well, look at where we're at 2 days later, and it's not that I was going to predict precisely that the next 2 days would be the bounce, but that's exactly what's happened. So the 10-year Treasury is rallying once again, unfortunately, and I say unfortunately because what we've seen this year is that when the 10-year Treasury is rallying, typically the stock market is selling off. And when you look at the S&P 500, it was down a touch yesterday, and it was down more than 1% today, and that coincided with the 10-year Treasury up 2 days in a row right there. And you'll notice that the bounce has been aggressive enough to actually revert that posture back to strongly bullish on the 10-year Treasury. So when you hear me say things like I did on Tuesday, where I don't really trust the posture in that case, where you still have clear evidence of support with that trend, that's exactly what I'm referencing. Now, I did say the same thing about the US dollar as well, but you will see that there's a slightly different outcome with the US dollar, which is actually a little bit surprising to me, because like the 10-year Treasury yield going up nicely the last 2 days, so did the US dollar. It's just that I think there was enough bearishness leading up to this last 2-day rally, because remember, the US dollar was down 4 out of the last 5 days, and it was a pretty sharp sell-off, right? We were way up here, and we corrected all the way down to the moving average itself. With the 10-year Treasury, it did not sell off all the way to the moving average. So I think that's why there's a difference between the background colors on these two. But it looks to me like the UUP is more likely than not to join TNX with a strongly bullish posture once again, because this thing bounced exactly where we thought it could. Remember, this was the candle we were looking at when I was last with you on Tuesday. I was saying this is going to be the place, this is the make or break place where if you think it's going to be bullish, it's going to bounce from here. And that's exactly what we saw here in the last 2 days. If I right click on that, maximize it, you can see that that green line has really flattened out, but because it hasn't actually kind of rolled higher, you can't color that background color green quite yet. You know, when we look at TNX, notice that it fell out of the upper reversal zone with its green line, and it's now just slightly going higher, and that's why the background color went back to that dark green. But UUP is just not quite there yet. If UUP is up again tomorrow, and even if it's not, I would say if it's flat or up tomorrow, there's probably a decent chance that that's all that will be required to get that green line back riding higher again and the background color to change to green. So let's find that out tomorrow, but that's my guess. Now, if tomorrow's a really bad day for the US dollar, then all bets are off. But if we have just a quiet, sideways day on the dollar or an up day on the dollar, I'd venture to guess that we'll probably have a green background color on UUP, just like we do today on TNX. So that's not a good sign because those two areas, as those of you that have been watching these videos long enough with us this year will know, typically when those two bottom corners on chart 5A are green, that's telling us bad things about the risk appetite of the rest of the market. And it's not really an environment that is conducive to having stock prices go up dramatically. So if anything, if you are wanting to be bullish stocks, you should be hoping that UUP and TNX roll over and have really bearish charts, but that's not what we see right now. We see very strong charts there, and therefore that's probably not a great sign for the stock market. Things can change and things do change. So eventually that will change. It's just a question of whether is that going to change in the short term, which is what most traders care about. If that changes 6 months from right now, who really cares, right? But for right now, you kind of have to lean on the trends, know what they're doing. And right now, we still have an uptrend on UUP for the US dollar, and we still have an uptrend on TNX for the 10-year Treasury yield, and we still have a downtrend in place on the S&P 500. And we could carry that thought a bit further with foreign stocks as well. It's not just US stocks. We still have a downtrend on EFA and EEM. So, developed and emerging foreign stocks still struggling. And notice that both of those were down today as well. No surprise. When the US dollar is up, you should assume that foreign securities will probably do somewhat poorly. EFA did worse than the US today, down 1.75%, but somewhat surprisingly, EEM actually hung in there like a champ. It was only down 0.6%. Remember, some of the emerging markets do have a higher concentration of oil companies that make up their markets than what we see in the United States. Remember, in the United States, the oil sector is basically an afterthought, especially compared to the way that we used to think about it 10, 15, 20 years ago. The market caps of the oil sector are not all that important, quite frankly. The giants of our world today are the tech giants. It's not ExxonMobil and Chevron anymore. But over in the emerging markets, you do still have very powerful players. For example, Petrobras over in Brazil, or the big players in Russia, as an example, in the oil fields there. So anyway, maybe that is the reason why emerging markets were able to hold up a little bit better today, despite a pretty strong US dollar. You'll notice that the commodities were a little bit of a mixed bag. Gold was down today, but oil was up, right? When we saw Energy stocks being basically the only area that was consistently green in the heat map earlier, that should have probably alerted us to the fact that oil was more likely to be up than down that day, and that was the case here. So they were able to offset the strength in the US dollar and went up for their own reasons today. Gold kind of played that more traditional role. When the US dollar is strong, commodities are more typically weak, and that is what we've seen here. With the US dollar up 2 days in a row, gold has been down 2 days in a row. But notice when the US dollar was down for that straight week, the gold was up for that straight week. So you kind of see those two more times than not kind of being like a Rorschach test of one another, an ink blot test, where they kind of, you push the ink together on the piece of paper, you open it back up, and they're opposites of one another. So we kind of saw that play out today. You'll notice here that gold does remain above its moving average, but that moving average is still falling. That's the case with oil, by the way, as well. But point being, there's been a little bit more resiliency here out of gold that we didn't really see all that often in the past. So who knows? Maybe this thing can get a little bit of traction with these levels here. Excuse me. The bond markets were largely lower today. Again, that makes sense. Typically, when interest rates are up, most bonds will be down, and that was the case. Long-term treasuries were down 0.56% today. Foreign bonds were down 0.23%. High-yield bonds were down 0.3%. You'll notice that of those three categories, it's only the long-term U.S. treasuries that remain in this bearish red or pink color that we see here. This is one I need to keep my eye on, by the way, as well. Remember, I have a sold put on this one for this portfolio here, and I think it expires in October, and I'm pretty sure we sold the 101 strike. We're at 101.98. So this is one that there's no guarantees it expires out of the money, and I'm going to have to keep it on a shorter leash. So remember, those of you that are premium members, you can look towards our Telegram channel. That is only given to our premium members. You cannot find it publicly on Telegram if you're just searching for it. We have to give you the specific links. But if you are one of our premium members, that's a benefit there that, if I need to make adjustments to these trades that I'm placing on the Market Outlook videos, I'll let you guys know there what those trade decisions are in the Telegram channel. So keep your eyes on that possibility. Right now, it hasn't really breached it, but we've got 3 weeks left, and we could certainly be below 101 by the time October expiration happens. So you got to stay vigilant with some of these trades that are in downtrends like this one is. All right, let's go ahead and now take a look at our sector 12 grid, chart 5C. And as you can see here, it's a little bit more of a mixed bag. We at least have a few more green charts popping up here or there. Remember, when I was last with you on Tuesday, we only had 2 green sector charts, and that was energy and that was healthcare. Today, we've got a few more that are popping up. I already talked about the S&P 500 at large reverting to a weekly bullish posture, but that includes the financials, the industrials, and materials today. And those 3 were in the bearish territory as recently as Tuesday. So, they have advanced at a more rapid rate off of their lows and have basically earned their way to those more bullish postures. Compare something like utilities and industrials to something like, materials and industrials to utilities and REITs down below. Notice how utilities and REITs are basically now back to their 3-month lows, whereas industrials and materials are still basically holding the big move we had from Monday and Tuesday. So that, explains the difference. Remember, stocks in general are largely correlated to one another, but they're not 100% correlated. There will still always be some outperforming areas and some underperforming areas. And so the acknowledgement of that is basically being guided by where those stocks are, these ETFs, I should say, are trading in relation to their recent price ranges. With utilities and with REITs, they're breaking down to new lows. They deserve to keep having a strongly bearish posture, but materials and industrials and financials have started to earn their way into more bullish mindset. I'm not going to go on record saying they're out and out bullish because of the same thing I told you about my thoughts on the S&P 500 in general. Until we're actually trading above the moving averages, I'm going to approach them more cautiously. But if they are eventually going to go bullish, it's got to start somewhere. And who knows, maybe it did start the other day with those specific sectors. So we'll keep our eye on that. And if things change along the way, of course, we'll be here to report upon it with these market outlook videos. But it is true that energy remains kind of the stalwart of this market. Remember, on Tuesday when I was with you, it already had a strongly bullish posture. Healthcare was weakly bullish, and that remains the case here. And I think it deserves to remain the case because energy has gone up the last 2 days. And remember, the stock market has been down the last 2 days. So if it was already strongly bullish before that, it most certainly has to continue to be after that. There is relative strength in the oil stocks right now compared to other areas out there. There is relative weakness in REITs and utilities right now compared to the other areas out there. By the way, the REITs have gotten so bad that they have an oversold cluster signal yet again today. That's after this Monday, Tuesday bounce that the market had. That was the strongest 2-day rally that we had in 2 years. So despite that, REITs still have an oversold cluster signal because they've given back all those gains from Monday and Tuesday, whereas most of the rest of the market has not. In fact, most of you guys know that when I do my market outlook trade application examples, typically when the market itself is down 1% or more, those are days that I bring sold put ideas to your attention. But today was a little bit of a goofy day from that regard because, as I mentioned previously, I didn't know in advance that the market was going to close more than 1% lower today because a half an hour before the market closes, which is when I'm trying to get my trades done to give you guys plenty of time to place the trades yourself if you so desire, because again, remember, I'm placing these trades while the stock market is open and then sending them out via our Telegram channel so that way you guys can consider them for your own paper money accounts if you so desire. But anyway, a half an hour before the market closed today, the S&P 500 was not down 1%. So I was kind of moving forward with my trade application example, making the assumption it wouldn't be down 1%. Now we know in hindsight, when the closing bell rang, it did close just barely over 1%. Well, had I known that for sure in advance, I probably would have been looking in the real estate investment trust world for some sold put candidates because that's an area that has been absolutely blasted and there are a lot of oversold cluster signals in that particular area. I have no doubt that when I send you guys out the email tonight that if there are oversold clusters on daily charts here today, there will be a number of REITs and probably utilities as well of that group. So I haven't actually checked that yet. I usually do that right before I send the email, but you guys will be able to spot check me on that and see if indeed that ended up being the case. That's my hunch right now, is there's probably going to be a lot of REITs with oversold cluster signals on tonight's email that we send you. So anyway, maybe that can be kind of an honorable mention trade idea for some of you. Look in the REIT space for some sold put ideas. That would have been possibly what I would have considered had I known for sure that the market was going to be down over 1% right at the close today. But since I didn't know that, what I opted to do instead was look for a bearish trade, because I have more bullish trades than bearish trades in my portfolio right now, and I'd like to kind of balance things out there. Remember, I was kind of out of sorts there for about a week and a half as a result of me having COVID and being laid up in bed a little bit more often than I would have preferred. So there could have been some of those days there along the way that maybe I would have taken some bearish trades that basically got X'd out. And so instead I'm playing a little bit of catch up here, trying to find some appropriate bearish trades here and there that we can consider. So what I ended up doing was looking towards the consumer discretionary area for a bearish trade. Now remember, I did a consumer discretionary trade on Tuesday as well with Starbucks, and that was a bullish trade. And Starbucks has actually done okay. It was down just a touch today, but yesterday it had a great day when the market was down. So far so good on that bullish Starbucks bull put spread. But today I wanted to kind of turn things around and look for a bearish trade. And so let me go ahead and pull up chart 3A. And the stock that I ultimately chose for the trade application example is DLTR. This is Dollar Tree. And so as you can see with this chart that focuses its attention on the blue line more than the green line, our background color changed from blue to pink. And what that signifies is this blue near-term line is now considered bearish once again. Yesterday it still would have been considered bullish, but because that blue line fell out of the upper reversal zone today, it now is considered to be a bearish swing trading idea, right? The blue line we match up with swing trading, the green line we match up with intermediate trend trading. Even if I were looking at this from the green line's perspective, it would still be considered bearish as well, because the intermediate line has not yet broken above 20. Now that might happen as soon as tomorrow because it's at 19.56. That would not surprise me in the least. But it is true that for this moment in time, it is still considered bearish on both the blue and the green lines. Now in addition to that, you can see that Dollar Tree has easily underperformed the market at large. This S&P 500 dotted line up here is well above this company's price candles. Remember when I was talking with you on Tuesday with the Starbucks example, it was exactly the opposite. I was telling you that Starbucks was an obvious market outperforming security. Dollar Tree is an obvious underperforming security versus the market, which is why I'm focusing the bearish trade on this one as opposed to Starbucks. The other thing that you can see here is that the moving average continues to go lower. Now price is above it, which is why the moving average is now yellow instead of red. So maybe that's not ideal, right? There's never going to be a perfect trade setup out there. There's always going to be some flies in the ointment, so perhaps that's one of them. But another reason I kind of like this particular trade is, to me, it feels like this stock is stuck in a bit of a box or a rectangle. And it seems like where we're at right now is where we've seen this stock sell off in the past. We've seen it sell off at that same area right there, and then back here as well. And then on the bottom side, it seems like this stock kind of stabilizes down here, maybe closer to like 135 or so. So we're kind of stuck here, but we're at the top end of that rectangle, which means that if it looks like it's rolling over like it is today as opposed to breaking out to the upside, then that might be a time to conduct a bearish trade on it, right? You wouldn't want to conduct a bearish trade down here at support with the possibility of it bouncing from there, but you might consider the possibility of doing a bearish trade up here at resistance if you needed to add some more bearish deltas to your portfolio like I do. The other thing that I was going to point out about this is I liked the strike selection. One thing I didn't like was the fill price. We did not quite get the 30% return on risk that we generally try to shoot for with these credit spreads. It was closer to 25%. So that was not ideal, but I did like the strike selection in general for this reason. The strikes that I chose in the month of November were the 155s to sell and the 160s to buy. Remember, this is a bear call spread that I'm doing here. So I would be selling the 155 November call and buying the 160 November call. So the 155 is really the driver of the trade. What we want for this type of a trade is for this stock to stay below that level. And you'll notice that this stock has a little bit of a funky looking chart here because we had this massive gap down that took place. And we've stayed below the high of that gap down day ever since then. And in technical analysis theory, that generally is the case for a more bearish chart, with the idea being if we had rallied strongly enough to breach that air pocket, that eventually that gap will get filled there. And I have no doubt that eventually it will get filled on Dollar Tree. The question is, does it happen in the next 45 days during the life of my trade, right? That's what I care about in this particular instance. But it has stayed below that gap down area this entire time. And notice 155, which is what I care about, because if we go through 155 to the upside, then my trade gets in trouble. But notice that 155 is up here well above the highest price of the gap down day. So as long as the sellers continue to step in and support that notion, then my trade should be protected. You'll also notice this one is a little bit off kilter in terms of when it reports its earnings. So I can get away with selling the November bear call spread and know that I won't have an earnings announcement disrupting it along the way, because it's probably not going to report earnings until late November, not mid-November. So that's also a nice little benefit with this individual stock as we enter into a heavy earnings season once again. The final thing that I'm going to point out is if we come over here to our 1040 crossover chart, where is that? Chart 4C, and I pull up Dollar Tree, and let me just right click so that way we can see this a little bit better. Notice that as of this moment in time, now remember it's only Thursday, so we've got one more day left in the week, so it's not confirmed until tomorrow afternoon, but as of this moment in time, the orange line has now crossed down and below the blue line. That's what we would refer to as a death cross. It's very similar to the concept of those of you who use daily charts with the 50 versus the 200-day moving average. In this case, it's a weekly chart, so we're using the 10-week moving average versus the 40-week moving average, but that is generally perceived as a bearish sign there as well with that death cross. Okay, so that's what I had for you, a bear call spread on Dollar Tree in order to add some more bearish deltas to our portfolio. I hope you enjoyed tonight's presentation. If you did, I ask one simple thing out of you in return, and that is to take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video for you at that time with another trade application example like the one I just showed you here a moment ago. Until then, I hope you all have a wonderful weekend. Enjoy your college football, your NFL, hopefully unplug from the markets a little bit. But remember, tomorrow is an important day with that jobs number, so buckle up. Until then, best of success with your trades and your investments. Goodbye for now.